Okay, we are back. I'm very happy to have on the Goldstein on Gelt Show Peter Schiff, who you may have seen because he appears regularly in the financial media. You've seen him in the Wall Street Journal, Barron's, Investors Business Daily, and much, much more. He also has a bank called the Euro-Pacific Bank that specializes in dealing with non-Americans who want the banking services and brokerage services. And one of the things that Peter is very well known for is his ability to explain concepts that most people don't get, and so therefore they ignore, and he explains them in kind of human terms. So, Peter, I want to talk to you about one of the human issues that I think people, it's so vast they can't get their hands around it, which is the U.S. government debt and how that actually might affect us and why we should really care. So start by just telling us, how can the U.S. government actually create so much money to create so much debt?
Well, they create the debt by borrowing. What's amazing is that they can borrow this money in the first place because it's impossible to ever pay it back. And so normally, if you're lending somebody money, being repaid is the most important element of the deal. You're not going to loan money unless the person who's borrowing it has the capability of repaying the loan. And the United States government has absolutely no ability to repay the debt, but people don't care, or they haven't bothered to think about it. I mean, sure, we can print money and repay the loans, but that might not do any good if the money we print doesn't have any purchasing power because we've printed so much of it because we have so much debt that we can't repay.
So if people aren't worried, well, let's start by the one guy who's particularly not worried, but who did in fact win a Nobel Prize in economics. Professor Krugman says that the U.S. could go trillions of dollars more in debt. How come he's not as worried about it as you are?
Well, I think you have to flunk a test in basic economics before they can even consider you for a Nobel Prize in economics.
You're hurting my feelings. Look, a lot of my guests here have, in fact, won the Nobel Prize. But okay, we'll take that with a grain of salt.
Yeah, but look, Krugman has no idea what he's talking about. In theory, can the government go deeper into debt? Well, sure. I mean, because we're already, $18.5 trillion in debt. So, I mean, 20 trillion, 21 trillion, 22, we're going to get there anyway. And of course, that's just the tip of the debt iceberg, right? The actual Treasury debt outstanding is a small portion of what the U.S. government owes. If you look at all of their liabilities, right, which would include Fannie Mae, Freddie Mac, the guaranteed student loans, guaranteed bank accounts, pensions, Social Security unfunded liabilities, Medicare. You will add all that, you're talking about in excess of $100 trillion of liabilities that the U.S. government has committed to, which, of course, it doesn't have the slightest ability to actually pay in real terms, meaning taxing the American public to repay the debt in money that has value. Sure, they can print money as long as they're willing to print it into oblivion, right, and wipe everybody out through, runaway inflation. But to repay the debt in real terms, it's impossible. But Krugman doesn't, consider any of this. Krugman just thinks, well, we can print as much money as we want, and it's always going to have value. And that's just not true.
Well, it seems certainly that the level of debt, let's look at it in a different way. We always tell people as investment advisors that past performance is no guarantee of future returns. But as well as I do, you say that to a client and he kind of ignores that fact and just looks at the past performance and assumes it's going to happen next year as well. The same thing's happening as people look at the debt. They say, okay, listen, every president, we always say this president has added more debt to the U.S. economy than all the previous presidents combined. And it worked, with Bush and Clinton and Obama, and so it'll work with whoever's next also. It just seems that people, why now is this something we should worry about?
Well, think about this. President Obama, when he does leave office, he will have added more debt. The debt would have doubled under Obama, so he would have added more debt than all the presidents that preceded him, from George Washington to George Bush. And assuming that happens again, right, if that pattern continues, Bush doubled the debt, then Obama doubled the debt. If the next president doubles the debt, then you're talking about taking the debt from 20 trillion to 40 trillion. And at 20 trillion, the debt will already be larger than the U.S. economy. So at 40 trillion, so obviously we can't possibly double the debt again. So something has to change. The question is, what is going to change?
All right, so take out your crystal ball and give me a sense. What is going to change? How can, sorry, even before I say that, I want to understand what is the implication of this to regular folks. At what point is it going to be a tipping point and all of a sudden the whole thing collapses?
Well, first of all, the level of debt that we have and the fact that the Federal Reserve has kept interest rates at zero, mainly because that's the most we can afford. I mean, the Fed keeps talking about raising interest rates, but the reason they talk about it is because they can't actually do it. But they don't want to admit that, so they keep talking about raising rates as if they were really considering it, but they have to keep them at zero because we're so broke. But because interest rates are so low and because nobody is saving and because the Fed's debt monetization, otherwise known as QE, has enabled such an enormous growth in the size of government and the burden that places on our economy, the economy is very weak. We don't produce, we don't create good paying jobs. So the standard of living for American people keeps falling as the cost of living keeps rising. So we're already dealing with the consequences of the debt. But ultimately, it's going to be catastrophic because it's going to produce a crisis where our creditors ultimately lose confidence in our ability to repay in money that still has value. And so just like investors have lost confidence in Greece or they've lost confidence in Puerto Rico, they're going to lose confidence in the U.S. and then we're going to have a real crisis. We're going to have a currency crisis. We're going to have a sovereign debt crisis, and that is going to dwarf the financial crisis of 2008.
We are talking with Peter Schiff, who is an investment advisor. He explains a great deal, and quite frankly, he's explaining a little more perhaps than maybe some of us even want to hear about how the economy works and getting us a little bit worried. How long until this crisis might actually hit?
Well, that you don't know. I mean, we're long overdue. It should have happened years ago, but it's hard to figure out when people are going to act rational after years of being irrational, after years of living in denial and in a bubble. And that's what we have right now in confidence in the Fed and confidence in the U.S. economy. How long did it take for people to figure out we had a housing bubble? How long did it take for investors in subprime mortgages to realize that the mortgages were worthless? Or the same thing during the dot-com mania of the 1990s. People believe foolish things until they don't. And you don't know what the catalyst is for all of a sudden people to come to their senses. But inevitably they do. And it usually takes longer than you would imagine. And from my experiences, the bigger the bubble, the longer it seems it takes for people to figure it out. Because the bigger the bubble is, the more people are trapped in it and therefore can't see it. And the more this psychology is reinforced, just by everybody agreeing with it.
So let's go over this scenario, which a lot of people do talk about, which is that let's say the Fed begins to increase rates. Now, one argument is simply they could not do that because the U.S. couldn't afford to support the debt that it has outstanding. But that would only be dealing with new issues. In other words, when the government borrows new money, but the old $18.5 trillion would still be at the lower rate. Couldn't this slowly work its way out? Let the rates increase a little bit, let the government slowly stop borrowing so much? I mean, isn't there a possibility for a soft landing?
No, that's impossible. It's just a crash landing. That's why the Fed doesn't want to land. But the problem is they're eventually going to run out of gas, and we're going down. But the national debt is financed with mainly Treasury bills. So yeah, there's some 10-year and longer maturities out there, but I think about a third of the national debt matures in less than a year. So all that debt, when it matures, has to immediately be refinanced at whatever the higher interest rates happen to be. So it's not just the new borrowing that is going to be subject to the higher rates. It's all the short-term debt that has to be rolled over will have to be rolled over at a higher rate. It's like an adjustable rate mortgage. If interest rates go up, the people that have 30-year fixed-rate mortgages in America, they're not going to see an increase in their bill. But the people who have one-year ARMs, they're going to see higher mortgage payments, which, of course, is another reason the Fed doesn't want to raise rates. Freddie Mac just reported yesterday their first quarterly loss in 4 years. They lost about, $500 million. And this is a big turn of events because Fannie and Freddie have both been generating profits, and they've been paying those profits to the Treasury, which has been reducing our budget deficits. But now that these companies, government entities are now producing losses, they're going to be sending the government a bill rather than a check. And think about this. If they're already losing money at Fannie and Freddie with interest rates still locked at zero, imagine how much bigger the losses would be if interest rates rose. Because these guys have been underwriting some very, very risky mortgages. They've basically taken over the subprime market because all the private subprime lenders went out of business. And so now all the subprime is being done by Fannie and Freddie, and they're lending money to borrowers who can't repay their loans with basically no down payments, very risky mortgages. And if interest rates go up, a lot of these mortgages are going to go into default again, and they're going to need a bailout again to the tune of hundreds of billions of dollars. So, there's so many reasons that the Fed wants to keep rates low. Corporate America is levered up to the max. We've got a bubble in auto loans. We've got a bubble in student loans. Everybody has got all this debt. The only thing keeping it together is the fact that rates are still at zero. And the other problem for the Fed is if they raise rates a little bit, right, 25 basis points, the market starts anticipating additional rate hikes. So it's not just the first quarter point that scares the Fed. It's the markets start anticipating more rate hikes after that, which ultimately crush the stock market, crush the housing market. And I believe if the Fed actually raises rates, the economy will be back in a recession much sooner, at least officially. We're probably unofficially in a recession. In fact, we're probably in a depression. But at least the way the government cooks the books, they can still pretend the economy is growing. But I think if they raise interest rates, they're going to have to stop the pretense, because I think we'll be back in recession. And that really scares the Fed, because the Fed doesn't want to raise interest rates slightly and then immediately have to bring them back to zero and then launch QE4, because that will expose the Fed and expose the economy for what it is. We're totally addicted to this cheap money, and we can never take it away. In fact, I don't even think 0% interest rates are low enough. Right? We need negative rates. We need more QE, because that's how addicted we are. That's how much debt we have. Now, none of this is good. We need to go cold turkey, right? It's not like a drug addict needs more drugs just because he's built up such a big drug habit and he has a high tolerance. I'm saying, no, let's go cold turkey. Let's get off of drugs. Let's go into monetary rehab.
And by that, just to confirm what you mean by that, you mean to cut spending dramatically. You're not talking about any other solution, are you?
Well, cut spending on the federal government, but raise interest rates. Interest rates need to go up a lot, not just a little, but we have to deal with the consequences of higher interest rates, which are going to be defaults on a massive scale, because we have too much debt. It can't be serviced, let alone repaid, if we have normal interest rates.
Well, the government certainly can't just do, in other words, as you're describing, if they let interest rates fly up 2, 3, 4%, as you said, that would be a huge shake to the economy. So there has to be some sort of middle ground. The middle ground is stop spending the money.
Well, we have to cut government spending, but that means a lot of people who have been promised money from the government aren't going to get it, because we have to cut the entitlements. We have to cut Social Security. We have to cut Medicare. We have to cut government pensions. Right? That's where the big money is.
I'm simply noting, by the way, you're leaving out of your list the raising of taxes, which I'm perfectly happy about, but I know that wasn't part of your menu.
Well, I don't think the solution is higher taxes, but higher taxes are better than these big deficits. I would argue that the damage to the economy would be less if the spending was being paid for by taxes. And of course, if the spending had to be paid for by taxes, the government couldn't spend it because the voters wouldn't allow it. The only reason the voters are allowing the government to spend all this money is because they think it's free. They don't think they have to pay for it. But I think if the voters were told, hey, here's how much these programs cost, and this is how much we're going to raise your taxes to pay for it, the voters would say, no, I don't want the programs.
Mm-hmm. Wow. We are certainly it sounds like quite a catch-22. And, of course, one of the other problems we have, Peter, is that we are just about out of time. We've been talking with Peter Schiff, who, as you can see, explains it like it is. Peter, in the last few seconds, just tell us, how can people follow you and follow your work?
Well, certainly you can go to my website for the bank. It's europacbank.com. Social media, you can follow me on YouTube, my YouTube channel, The Schiff Report. I do a podcast on schiffradio.com. You can go to my Facebook page or Twitter, read a number of my books that I've written, the most recent being The Real Crash, America's Coming Bankruptcy, How to Save Yourself and Your Country. You can see many of my books on my website, schiffbooks.com. So there's all sorts of ways that people around the world can work with me, can follow me, and educate themselves and help educate others to really understand economics and the true cause of economic growth, which is freedom, sound money, capitalism, limited government, and the biggest deterrent of economic growth, and that is government spending, government regulation. Government is out there trying to claim that they're the solution to our problems. Government is the cause of our problems. We are the solution to our problems, individuals.
All right, we will leave it with that. Peter Schiff, thanks so much for your time. We will put links to all of that at the show notes of today's show at goldsteinongelt.com. Thanks very much.
You are listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.